Good afternoon. So today I am going to take Unit 4, that is Financial Accounting and Financial Ratio Analysis. In the previous unit, I told about interest factors, and how to calculate various EMIs using various interest formula and all. And also told about calculating depreciation and methods of calculating depreciation, and also the components of various cost, estimation and costing also. Yeah, Mr. Change just. Okay. Good. Oh, good. Okay. Good point, huh? Okay. Good. Thank you. Okay, these things already told about in the previous class. So now in this unit, I'm going to focus on financial accounting as well as ratio analysis. So I will ask you one question here. I think, of course, all of you have gone to bank. So we are going for banks. We are going for banks. Maybe with two purposes. One, either to deposit or to withdrawal. Okay, there are two basic purposes of anybody to go to bank. Either to deposit or to withdrawal. So in banking terms, they call it as debit and credit. Just if you want, you can see the passbook and all. You can see that how much amount has been credited by the customer and how much money has been debited. So they say in terms of debit and credit in the banking terms. So here, in fact, I want to highlight some of the basics of accounting terms, so after knowing the theoretical background, you can solve the problems. I can also prepare a profit loss balance sheet, and also can find out various ratios. Okay, that you can do it. So I'm going to give some basic idea about the basic terms of financial management. So there are two accounting systems are there in. One is financial accounting, second is management accounting. So financial accounting, that is reporting the financial information to investors. There are so many people who are going to invest in the organization. Okay, that is they are also called as stakeholders. Okay, that is the stock the shareholders, or you can say the people who purchase the bonds or debentures. Okay, so those people are called as the investors. So financial accounting, basically, that is reporting the financial information for all these stakeholders. This is called as financial accounting. Next, management accounting, that is basically caters the needs of the internal use. Management also wants, okay, how much, what is the income, what is the expenses, okay, how much is, basically to calculate or to prepare budget and all. So they want this information. So management accounting basically catering needs of the internal users, nothing but the management. So one more term you should know that's about in this unit, that is balance sheet. That is a statement of financial position. It indicates the financial condition at a particular moment of time. Normally, you would have seen that the balance sheet as on 31st March 2020 or 31st 12/2019, something. Okay, that is actually, so balance sheet basically indicating the statement of financial position and indicating the financial condition at a particular moment of time or during some period. Okay, that is called as the balance sheet. Next year, some more terms here. Normally, when you talk about an organization, normally they're going to say, so this much of assets we have, At the liabilities we have this is. Normally you should know about what do you mean by assets, what do you mean by liabilities. Okay, what do you mean assets? So yes, asset basically they are the economic resources, valuable position owned by a firm. Okay, they are basically the economical resources. Measurable in monetary terms. Remember, anything in the organization, okay, whether it's going to be equipment or a material or raw material or anything in the organization, that should be converted into monetary terms. So they are called as assets. That we can say economic resources, valuable position owned by a firm, measurable using monetary terms. For example, cash receivables, stock, that is how much inventory they have on hand, and land, that is the land they are going to have for the organization to build on land, buildings, the plant, equipments, raw materials, finished goods, and the WIP, that is work in progress. All these are the assets. They can be converted into monetary terms. Means they can sell it off and they get money in turn. Nothing but you can say it. They can be converted into monetary terms. And also they can measure okay, this much of worth of assets we have, this much of worth of plants we have, this much of worth of inventory on hand we have, this much of money we are expecting from the outsiders. So cash receivables. So all these things called as the assets. So there are various types of assets are there. So I just I'm going to brief here only a few assets here, that is can be classified as current assets, investments, fixed assets, and deferred charges. So they are called as the current assets. So I'm going to deal in detail while solving problems. Next, of course, liabilities. I told you in the beginning that is normally in the organization they talk about two things. That is one is assets and liabilities. I told that assets are the economic resources convertible or measurable in terms of money values. So here, what do you mean liabilities? Liabilities are the debts payable in future by the firm to its creditors. Remember, so they are the payable amounts in future by the firm to the creditors. Means this much liability we have, this much money we have to pay to the creditors. Okay, that's called as a liability. They represent economic obligation. It's the obligation they have. They have to pay this much. They have to transfer this much. They have to exchange this much. Okay, that is called as the obligation the organization have got. They represent the economic obligation to pay cash or provide goods or services in turn for some future period. That is called as the liability. Generally, liabilities are created by borrowing money or purchasing goods or services on credit. When they're going to buy anything, any goods or a plant or equipment or anything on credit, they are called liability because they have to pay in future. It's called as the liabilities. Next example here, what are the examples? That is the creditors, bills payable later, wages payable to the laborers, salary for the employees, interest payable, okay, for the amount they have taken, a loan amount they have taken, interest payable, and taxes payable. Of course, at the end of it, they are supposed to pay tax, never called as GST, they are supposed to pay taxes. Bonds, okay, there so many people are going to purchase bonds for investment transaction as okay, that is shareholders. Debentures, somebody might invested as a debenture bond, and the bank loans and loans from financial institutions, other institutions like state financial SFC, RICIC, and small scale industry, SIDO and all. Okay, all these things are also going to provide loans. So they are going to supposed to pay loan for this. So all they are called as the liabilities. So there are two types of liabilities. One is current liability, means as on today within the financial year they are supposed to pay, it is current liabilities, and second is long term liabilities, means they have got some time to pay in future. There are two types of liabilities. One is current one, second is long term liabilities. Next here, so just I am going to talk about that is the financial statement analysis. What do you mean by financial statement analysis? Okay, that is the assessment of the firm's past, present, and future financial conditions. Okay, what are the financial conditions in the previous? Okay, how the firm was did in the previous years? What actually now presently doing? What is the future condition of the organization? So indicating the past, present, and future financial conditions. It is basically to find firm's financial strength and weaknesses. By understanding the first, by knowing the or by analyzing the financial statement, you come to know that what is the strength of the organization and what is the weakness of the organization. There are so many tools are there for analyzing the financial statement. Of course, one is preparing the financial statement and the comparison of financial ratios to past and with respect to industry, with respect to the sectors, various sectors, with respect to all firms. So they can use. These are the three primary tools used for analyzing the financial statement of the organization. Next here, okay, just before solving some problems, understand some of the basic terms used in financial statement analysis. Okay, one is of course that is profit and loss account. Okay, also called as, simply called as P&L account. Okay, profit loss account. So a firm's financial strength is measured by its earning capacity. Normally, when you say that the organization is doing better, their prospects are too good, they have got too much of prosperity, and they are doing too well, they are doing well. When we say that a firm financial strength is measured by earning capacity, how much money they could able to earn back. I think we can say return on investment, or also called sometimes payback period, how many days or years or months they take to money back. The earning capacity and potential of a firm are reflected by P&L account. So the earning capacity of the organization and also the potential of a firm means whether they could able to get that money back or they could able to return the investment and all. Those things are reflected in the profit loss account. It's a scoreboard, remember. So sometimes called as also going to call something called as scoreboard because everything are shown in the numerical values, numerical terms. This much of worth of profit in terms of rupees or any monetary values, dollars or something like that. Okay, so that is so basically showing all the values in terms of numerical values. Okay, in terms of numbers. That's why you can say it's a scoreboard during a period of time. I told that normally we're going to calculate as on 31st March because normally the financial year starts from 1st April to next to 31st of the March. It's called as a financial year. Okay, so it's a scoreboard during a period of time. P&L account gives a summary of revenues, expenses, and net loss and the profit firm. Okay, so it's very important. So normally they're going to calculate how much is revenue expected from this sale of goods, or in terms of sale of goods, or sometimes they're going to dispose the old machinery and all. Okay, also called as I think scrap value, resale value. I told you in the previous chapters, that is in the chapter like depreciation or in the comparison of present worth. I told you these things, resale value and all. Okay, so sometimes they're going to get income, also called as revenues. Okay, nothing but income. Okay, income, and also they have to calculate the revenues. Okay, and net loss and the profit of firm. Okay, what do you mean a revenue? Also called as income. Okay, normally in account terms they called as revenues. Okay, revenue. Revenues are the amounts which the customers pay to a firm for providing them goods and services. Okay, the revenue. Okay, revenue. Income. How they going to get income? How they going to get income for organization? That is, they're going to pay for a firm providing them. So when they're going to sell the goods, when they're going to provide services, in turn they're going to get some money. Nothing but revenue. Okay, that is money in. Okay, that's what the revenue. Nothing but income. Okay, so there are two types of revenues normally. One is operating revenues. They are arising from main operations or a business. Okay, that is direct sale of product. They're going to get the operating revenues. Okay, by direct sale of goods or a final product. Next, non-operating revenues. So that is called as also called as they are basically indirect or incidental revenues. You know, suppose sometimes government going to announce that these MSMEs are going to get so much of a benefit in terms of subsidies. Subsidies are non-operating revenues. Don't know whether they're going to get or not. Sometimes government is going to waive off the interest, so that much of money they could be able to save, nothing but so say they are called as normally called as non-operating expense revenues. Indirectly they're going to get for the organization. Okay, or also sometimes incidental they're going to get the revenue. So there are two revenues. One is operating, second is non-operating revenues. Of course, example I have given here. It is an example for non-revenue. that is a sale of old equipment, that is okay, sale of old equipment, okay, scrap, okay, resale value, the scrap, and dividend, okay, so they are going to get a dividend for the money invested and all, interest or income from temporary investment, sometimes, so the amount may have for 1 year as a fixed deposit and all, or may have invested somewhere, so suddenly they are going to get some income and all, okay, so they are called as the temporary, so they are called as non-operating revenues. And next, after revenue, it is expenses. Okay, revenues and expenses. Okay, that is expenditures also, sometimes called as expenditures, nothing but expenses. So, what is expenses? The cost of earning revenue. Revenue. That is, if you want to earn profit, if you want to, you want income, or if you want revenue for the organization, profit, income, or revenue, anything. Okay, of course, you should invest some cost. Nothing comes free. Okay, so cost by selling the goods, by manufacturing goods, okay, by manufacturing product, you're going to get profit. So basically, expense nothing but the cost of earning revenue. They occur when assets are consumed or liabilities are increased to provide revenue. Remember here. Okay, remember here, two things. So when they're going to get expenses, one is when they occur and the assets are consumed. Okay, assets have been consumed, no money has come. Okay, they become expenses. Assets consumed now. Or liabilities are increased. Okay, they're going to supposed to pay in future. Lots of liabilities are there for coming years and all. So they are to produce, increased or to produce revenue. So they are called as expenses. Next, types of P&L account, that is profit and loss account. So P&L account reveals information about revenues, expenses, and the income or loss of the firm. Remember, okay, that is, I told you it is a profit, revenue, and income and all synonymous terms. But thing is, even though that is the revenues and income, loss, expenses are normally in the accounting terms, they are going to treat differently, because normally what happens here, in engineering terms, we go with only either profit or loss, either going to say with expenses or income, something like we say. Just like I told in bank, we say that we're going to deposit and we're going to withdraw something, these two things we say, no? So, but banking terms, they say that debit or credit. But here, similar way, in the accounting terms, they're going to treat these terms as different terms. That's why P&L account reveals information about revenues, expenses, and the income or loss of the firm. The heading includes, normally when they're going to prepare a P&L account, we're going to provide the heading. Okay, that is P&L account for the companies, Voltas company or LG company, we say like that. So that is the heading includes the name of the firm, type of statement, and period of time to which the statement relates. We are going to write three things here, basically. That is, one is the name of the firm. That is, I told you, name of the firm. And next, the type of statement, whether I am going to prepare a profit and loss account, or you going to prepare a balance sheet. Likewise, you have to write what exactly you are showing. Okay, that is, and also the period of time to which the statement is relates. That is, whether you are going to do for this financial year or a previous year. Okay, those things should be shown. So these things are very essentially in the profit loss account. So here, of course, these things are going to be depicted in the P&L account. That is the manufacturing expenses and general administrative expenses. I told you, I think in unit number 3, I talked about that is all the components of cost. That is the prime cost, fixed cost, manufacturing cost, production cost, factory cost. Okay, selling price, profit, those things I told. Okay, so there are so many components of manufacturing costs are there, expenses are there, and also there are so many administrative expenses also there. Okay, that is the rent for building, taxes payable, salary for the employees, okay, electricity fees, and those things are there. Okay, so they are all called rather the expenses. I told you already in the previous unit, which I am not covering here. But only thing, these are also included in the expenses. Next here, profit. Okay, the concept of profit. Okay, just like asking somebody what is the salary or a package offered by some company. They say they offered 12 lakhs per annum. They say it. So it does not mean that they're going to pay 1 lakh salary for a salary per month. It's going to be called as cost to company, C2C. I think you know the cost to company. It involves all the other expenses involved in that. So maybe at the end he may going to get a gross salary of a net salary of say around 90 or 900 rupees or 800 rupees, by deducting all the expenses incurred for a person by a company. Okay. So here, that's why we're talking about here the gross profit and profit before tax, before depreciation, before interest, before taxes, and profit after depreciation, profit after interest, profit after taxes. So it's very important to remember when you're going to prepare a P&L account, you should know whether you're going to calculate the profit as a gross profit, or you're going to calculate the before depreciation or interest or taxes, or calculate afterward. So these are the things they're going to highlight. So these terms, okay, that is about, first of all, you see, what do you mean by gross profit? So GP. It's a difference between sales and the cost of goods sold, including the manufacturing costs. Okay. Difference between sales, how much worth of sales? Okay, worth of sales. So maybe 1 lakh worth of, okay, a sales price, okay, sales price. Okay, by taking into account total sales volume multiplied by the rate of product. It is, you know, how to calculate selling price. So it's the difference between sales and the cost of goods sold. Cost, how much the expense involved by selling the goods. That is sales commission, distribution cost, administrative expenses, and those things are there. Of course, you can't directly straight away take a product and give it to any organ. You're not going to directly sell it. Okay, so it involves a lot of expense involved also to sell it. So basically, this gross profit, a difference between the sales and the cost of goods sold, including the manufacturing costs. So one more thing, normally, in the accounting term you're going to use PBDIT. Okay, PBDIT. It is profit before depreciation, interest, and taxes. Okay, of course, it's also sometimes similar to GP, because GP, gross profit also includes all these things, that is depreciation, interest, and all. So PBIT, it is equal to revenue, total revenue, minus all the operating expenses, including depreciation, interest, and taxes. That's called as a PBDIT. That is profit before depreciation. Before calculating depreciation, of course, you know, normally any machinery or equipment or tools or a plant or a building, anything, they have to be depreciated, because so at the end of economical life, you know, already told about the asset life, economical life, okay, those things, accounting life and all, told you in the previous unit and all, okay. So see, remember here, so when they're going to calculate the profit, they have taken into account the depreciation of the plant. Okay, maybe at the end of every year they have to deduct some amount. This is the depreciation, maybe 10% and all. Depreciation for the machineries. Okay, so at the end of economic life of the machinery, it has to be replaced. Okay, because you can't use the machine for so long time. Okay, there are some life accounting economic lives are there for each and everyone. So the PBDIT, that is profit before depreciation tax, takes into account depreciation and interest and also the taxes. PBDIT is equal to revenue minus all operating expenses, including the depreciation, interest, and the taxes. Next, one more thing that is called as OP, that is operating profit. Remember GP and OP. That is GP, basically it is a gross profit before calculating the depreciation, interest, and the taxes. It is OP, that is operating profit. It is actual profit, it is net profit. It is PBIT, before interest and the taxes. Also sometimes called as EBIT, that is earning before interest and taxes given by, OP is equal to GP minus all the expenses incurred, operating expenses, minus the depreciation. Okay, that is PBT, Okay, this is given by PBIT minus interest. One more thing also called as a PAT, that is taken only tax, that is profit after tax, before tax, after tax, PBT and PAT, that is given by PBT minus tax, that is subtracting all the taxes involved, okay, like GST and all. Okay, they're going to calculate profit after tax, okay, that is PAT. Next, what are the functions of profit loss and account? Okay, after knowing that profit, revenues, expenses, profit before tax, profit after tax, okay, knowing about when they're going to calculate depreciation, interest and revenue and all. So now, what is the function of the profit and loss account? One, of course, it accumulates economic data. Economic data. Okay, it is the revenues and expenses in accordance with the account paid period. Okay, for any particular period, that is going to show the exact data about the revenues and expenses. That's why it's going to called as it accumulates the economic data. Okay, economic data. It is the revenues and expenses. So here, remember here, I told about net profit. Net profit is equals to revenue minus expenses. For the revenue, the organization has got subtracting all the expenses. Okay, that is the net profit. Next here, one more thing, second function of P&L account, that is it measures the net profit by matching revenue and expenses. Okay, I think by solving problems in while preparing balance sheet and all, I'll tell you how exactly you're going to match the revenues and expenses and all. Okay, I'll tell you later the solving problems. So the second function of P&L account is matching the revenue and expenses. And the third, it communicates the information, financial information to all the stakeholders. Remember, there are many people. Okay, I told you already, that is the shareholders, the people who purchase bonds, the people who purchase debentures, the bank people, and other financial institutions, they provided the loan for the organization, and of course the public, and the customers, and the suppliers, manufacturers, distributors, and the management, and even workers, all are the stakeholders of the organization. So everybody wants to know the organization, financial capacity of the organization, strength of the organization. That's why. So basically, P&L account that communicate the financial information about to all the stakeholders. That is the capability of the organization in terms of financial capacity. Okay, those things, they are the functions of P&L and account. Next, how to prepare now? Okay, after knowing functions, then we have to prepare P&L and account. Okay, that is a profit loss account. Okay, that is first step. That is initially the gross profit and gross loss as obtained from trading account is transferred to P&L account. So there is something called as the trading account. All the gross profit, gross loss. Remember, gross profit, gross loss. Okay, including depreciation, interest, taxes, everything are shown in the trading account. Those things are transferred into P&L account. Next, the gross profit and incomes are entered on credit side. Remember, I told in the banking terms, they're going to use that is credit and debit. These two terms, okay, they are the banking terms. So remember here, so there are going to be two sides in a P&L account. One is the credit side, second is the debit side. So in the credit side, they're going to show the gross profit and incomes entered in the credit side, and the gross loss and the expenses are entered on debit side. Okay, so they're going to show. So while solving problem, understand it, how they're going to enter these two separately. That is in the credit side and the debit side. Oh. Yeah. We'll take some problems now. So you can understand you'll understand how to calculate all these units. I told you, how to enter the values in the credit and debit side. So I'm going to solve some problems here. Yeah, these are textbooks you are supposed to refer for this unit, Elements of Management Accounting by I.M. Pandey. So I prepared these PPTs based upon some of the slide shares downloaded from Google and all. And also I referred this textbook for preparing these PPTs. And of course, for anything extra points required, you can refer the textbook by I.M. Pandey. That is the Elements of Financial Management Accounting by I.M. Pandey. The best book. You can refer any edition. There is no restriction of which edition only supposed to use. You can use any edition of I.M. Pandey.